Hello everyone and welcome back to the podcast. This is my deep dive on Chegg, a company which is currently priced for bankruptcy, but that may actually have a bright future ahead, and I think it's quite likely. Chegg also teaches tech investors a terrifying and equally valuable lesson, and this is that disruption comes when you least expect it. Let's get deep into it. ChatGPT has disrupted Chegg's business by reducing the willingness of customers to pay and by becoming top of funnel. Customers just aren't so keen to pay when they have a free study copilot. In turn, Chegg has spent over a decade building an SEO, search engine optimization, traffic moat by indexing expert content. Now that moat is being eroded as students ask LLMs, large language models, questions instead of going via the traditional search engine route. As of Q3 2024, Google is now answering student questions in situ, so without redirecting users to anywhere else, featuring Chegg's links below said interface. As a result, global non-subscriber traffic to Chegg was down a whopping 37% year over year in October. However, at a quick glance, the financials reveal that the stock market may be overreacting to this development. As you can see in the graph below, cash from operations, which is the orange line, is back to 2020 levels at present, while the stock price, the blue line, has plummeted. The relatively buoyant cash from operations levels elegantly summarizes Chegg's fundamental situation. ChatGPT does present a headwind to the business, but likely not as much as the market currently believes. Hence, Chegg may be a highly asymmetric opportunity at present. At just 0.38 times sales, Chegg is priced for bankruptcy. However, some quarters before the departure of the previous CEO, Chegg started working on building out a Duolingo-like infrastructure that leverages their proprietary data to deliver an AI-enhanced student experience that's more accurate and reliable than generic LLMs. Chegg has decades of data on what works for students and what doesn't, which positions them to potentially outperform. In Q2 2024, CEO Nathan Schultz said that per their research, receiving incorrect information is a top concern for 47% of generative AI users, and that 75% are willing to pay for a service that's designed to produce better outcomes. Although subscribers are down meaningfully year over year, as you can see in the graph below, the total number of questions asked on the platform is actually up 79% year over year as of Q3 2024. In H1 2024, so the first half of the year, the number of questions asked was up a notable 109%, coming in at a total 16.2 million questions just for the first half of the year. As of Q2 2024, 70% of students were participating in conversational instruction with Chegg's AI models. The two aforementioned metrics indicate that Chegg's new approach is resonating with consumers, which likely affords Chegg the traffic to then build features that ultimately improve student outcomes per dollar spent per vertical at a pace superior to that of generic models. These features are yet to be built, but I believe the company is now in good hands for the reasons that I will explain coming up next. Former CEO Dan Rosenzweig served from Q1 2010 to Q1 2024, taking the company public in November 2013. In Q1 2024, CEO Nathan Schultz took over, having spent 16 years working at Chegg previously. He is therefore familiarized with the education market and Chegg's mindshare among students in the US and globally. He currently holds around 0.5% of total shares outstanding, which is perhaps, in my view, not a sufficient stake. I would much rather prefer Schultz to be a founder-operator, which I have found is an essential component of a multi-bagger thesis. However, although there is little data to evaluate his leadership at present, Schultz's vision is along the lines of rapid iteration. The students of my tech stock Goldmine course, which is linked to in the show's footnotes, know is a leading indicator of financial outperformance. Therefore, although more quarters of continued execution are required to analyze and validate his leadership, philosophically, he is on the right path. Per the Q2 2024 earnings call, he is making strides to infuse Chegg with a focus on iterative product development as an organization. In the Q2 call, Schultz shared some insight on how this approach is already yielding features which set Chegg on a path to be competitive on the AI race. Here's what he said.
On the global product side, we are well underway in implementing our iterative approach to product development. This fall, we will be testing a variety of innovations. As an example, we have developed a feature internally referred to as starting point, which is meant to address the common issue of students simply not knowing where to start, whether they're studying for a midterm or writing an important paper. This introduces a whole new way for students to leverage Chegg on their learning journey. In addition to starting point, we've developed 2 new applications, one that keeps students on track and another that organizes students' notes and turns them into study tools. As we get more products into students' hands through iterative development, you are beginning to see the evolution of Chegg from a Q&A platform to one that delivers 360 degrees of support.
Chegg is currently pointing its AI infrastructure to what management terms as the 2 quote-unquote most relevant use cases, which are practice and solution comparison. By gathering data on these 2 use cases on what works and what doesn't, Chegg has a clear path ahead to train increasingly better AI models. This is the same path that Duolingo is on, except that they are far ahead with 8.6 million paid subscribers and 37.2 million DAUs, daily active users. As of Q2 2024, Chegg has added 3 key components to its AI architecture. 1, a mechanism that seeks to understand questions asked in depth, so to personalize the learning pathway for the students in question. 2, a multi-source approach, leveraging both generic and proprietary LLMs, as well as subject matter experts, so actual humans. And 3, a quote-unquote air traffic controller that selects the best approach to assist each student, screening for quality simultaneously. As of Q3 2024, there is some evidence already that these features are driving value. In Q3 2024, Chegg's study global retention rate came in at 81.8%, up from 78.5% just the last quarter in Q2 2024, with total subscribers down 9% and 13% in Q2 and Q3 2024 respectively. This means that the subscribers that are staying on the platform are actually more engaged. I suspect that the market will be looking at overall subscriber numbers instead of focusing on engagement. Higher engagement actually means that the AI architecture is working and that Chegg is likely on a path to being competitive again, which is really what matters for the stock price to rise again over the long term. I also wouldn't be surprised to see the market fixating on the declining ARPU, average revenue per user. As you can see in the graph below, ARPU has been steadily declining with the onset of subsequent LLM generations. However, AI is inherently deflationary to the education industry, as is the case with many other industries, and this means ARPU is a relatively futile metric in the context of the turnaround. What matters is free cash flow per subscriber, which is actually a function of the engagement per subscriber and the operating leverage the AI infrastructure yields. In the Q2 call, Chegg CFO David Longo shared some thoughts on how Chegg is thinking about this. It almost seems like he was talking about sharing economies of scale.
Thankfully, with our automated solutions rollout and our further integration of AI, we can serve those customers still profitably, bringing in a lower.
In terms of profitability, a superficial look would reveal that Chegg has taken a considerable hit, with net income plummeting in the last 2 quarters, as you can see in the graph on the screen now. However, this is largely due to non-cash expenses. In Q3 2024, Chegg registered an impairment charge of $196 million as a result of the continued quote-unquote industry pressure and the declines in the market capitalization. In the same quarter, Chegg also reached a settlement agreement to resolve the Leventhal class action securities lawsuit, recording a $55 million loss, non-cash again, for the estimated contingent liability. In turn, in Q2 2024, Chegg completed an impairment test on their goodwill as well. The test resulted in a $481.5 million non-cash impairment. This impacted their Q2 income tax provision in turn, as at that point they were in 3 years of cumulative pre-tax losses in the US. This triggered a further $141.6 million non-cash valuation allowance recorded on all US federal and state deferred tax assets. This is why when dealing with growth companies, watching the cash flow statement is paramount. Net income can decline drastically with the introduction of non-cash expenses, while cash from operations tends to be a more accurate reflection of a company's earning power. And indeed, as previously explained, Chegg's cash flow statement suggests that the company is not doing as badly as the income statement would have one believe initially. Per the aforementioned increased retention rates from Q2 to Q3 2024, it seems that Chegg Chegg is making good progress in terms of enhancing its value proposal. The bad news is that, as previously mentioned, its legacy custom acquisition channel is in dire straits. As LLMs continue getting better, SEO will likely continue losing market share. The 37% year-over-year decline in non-subscriber traffic in October is likely to only be the beginning. Per the Q2 and Q3 2024 earnings reports, however, Chegg seems to be making progress in developing new acquisition channels. They now have over 53,000 followers on TikTok, and in Q3 2024, they launched a Discord app and a Chrome extension in order to meet their customers inside their study workflow. Over the coming quarters, I will continue to study the company closely. Specifically, I'll be looking at the engagement levels to gauge the effectiveness of its newly deployed AI infrastructure. And I'll also be looking for signs that Chegg is able to reduce its reliance on SEO traffic, ideally diversifying into a set of acquisition channels. However, I walk away with a good impression of the management team. Chegg has non-zero odds of beating generic LLMs at delivering better student outcomes per dollar spent over time, and the market is not discounting this possibility. Additionally, Chegg shows tech investors why investing in tech can be so dangerous and why it's so important to invest in companies that are actively looking for ways to disrupt themselves. Let's get deep into this part of the deep dive now. In Q1 2021, Chegg was valued at an incredible $12 billion, which is 46 times more than today. And back then, the business was highly successful. The Q1 2021 earnings call was a victory lap, with CEO at the time, Dan Rosenzweig, comparing Chegg to Google. Here's what he said.
And I've never really seen, with the exception of maybe Google search, a business like this one. Meaning its growth rates, its gross margins, its EBITDA margins, its ratio of EBITDA margins to free cash flow.
Reading through the earnings call's transcript is terrifying because before the release of ChatGPT 3.5 in November 2022, there was no way to foresee the disruption that lay ahead unless you had a visionary understanding of LLMs. In Q1 2021, Chegg management was laser focused on putting more content out there to drive growth with great financial success at that point in time. Meanwhile, LLMs were a year and a half away from presenting Chegg with an innovator's dilemma scenario whereby what previously seemed like a toy quickly came to disrupt the business in meaningful ways. In the earnings call after Q1 2021, CEO Dan Rosenzweig began to gradually talk about AIs and LLMs. In the Q2 2022 call, Rosenzweig started to address AI as a friend and not a foe, stating that he believed it would improve Chegg's ability to quote-unquote provide support with grammar, paraphrasing, and set structure. What's even more terrifying is that his view made perfect sense in that he believed AI was going to decrease costs and enhance value delivered to students. He was totally right about this. He just didn't foresee that the combination of LLMs reducing the willingness of customers to pay and then disrupting the top of the funnel would lead to quite a bit of pain for Chegg. And I say this with all due respect because being a CEO isn't easy. Here's Rosenzweig's view about the matter in the Q4 2022 earnings call.
But our expectation, and I think you're going to see it from a lot of companies, remember, Chat, they've already said that they do not plan to keep it free. They can't run it if it's free. So it's going to be an API-based business where we will be participating and using it to enhance our product.
The argument was only really valid for a few months. ChatGPT 4 launched in Q1 2023, and by March of that year, Chegg was already feeling the pain. Chegg saw a quote-unquote spike in student interest for ChatGPT during that quarter, with customers starting to be a bit reluctant to pay. Here's what Rosenzweig said about this during the Q1 2023 call.
It's just on the margin that based on our research, that people normally who would have paid for us around midterms or closer to finals that were reluctant to pay or be longer term subscribers are now have a new free site to go try.
By the end of Q1 2023, ChatGPT and other LLMs had started to disrupt Chegg's custom acquisition funnels, and this trend is still unfolding today. Students are increasingly turning to these models for answers, with the models answering in situ without taking users anywhere else on the internet. This is a spectacular and highly unforeseeable form of the innovator's dilemma. LLMs seemed like a silly chatterbox at the start, and over time have considerably disrupted Chegg's core total value proposal, and the way they acquire new customers. That's disruption at two levels of Chegg's value chain. This is a reminder of the dangers of investing in the tech space. For Chegg, disruption came at a moment of maximum complacency and delight when the stock was trading at over 18 times sales. Further, although dealing with the disruption was very hard in real time, a company with a culture of constant self-disruption would have had higher odds of thriving. Per management's remarks in the quarterly earnings calls at the time, the company was uniquely focused on enhancing financial results by executing its old playbook more intensely every quarter. I found this statement from Rosenweig in the Q1 2021 Q&A section fairly insightful.
We are not trying to manage to any particular number except growth. So when we see an opportunity to invest, we do it. We are not holding back anything.
Meta is a great example of a company trying to disrupt itself by investing in the metaverse. Should virtual reality become the next frontier for social media, not being number one in the space would likely mean obsolescence for Meta. Rather than risking that possibility, Zuckerberg decided to invest heavily in virtual reality technology, although framed in an asymmetric manner, as I explained in my November 2022 Meta deep dive. The market has put tremendous pressure on Zuckerberg to stop doing so, including a 70% decline of Meta stock in 2022, as you can see in the graph below. Still, Zuckerberg continued to invest. Going forward, Schultz's management will be the defining factor for Chegg's turnaround. However, what enables them to orchestrate a comeback in the first place is their proprietary data. The latter is what ultimately enables organizations to train AI models that others can't, and I therefore anticipate will be the primary moat in the AI-driven economy. This is one of the main things that I teach students in my Tech Stock Goldmine course, in which I teach the mental framework behind my successful Palantir, Tesla, AMD, HIMS, and Spotify picks in under 2 hours and for just $300. Therefore, tracking Chegg over time will be fascinating for two reasons. It may yield a highly lucrative investment opportunity, and it will reveal to what extent a proprietary dataset is a moat or not when competing with generic AI models. All right, everyone, that's it for today. Thank you very much for joining me. If you enjoyed this, can I please ask you to share this with one friend? These deep dives are for free, and so the only way this grows is with your help. Thank you very much in advance. Take care, and until next time.